Welcome to the Deep Dive. Today we're digging into a company that's, well, really navigating some massive global shifts right now. IWG.
That's right. They're the parent company behind big names like Regus and Spaces, the flexible workspace providers.
Exactly. And they're not just tweaking things post-pandemic. They're making three huge simultaneous strategic moves. It's quite something to watch.
It really is. I mean, given their size, their decisions about where to invest and where to pull back act, almost like a real-time gauge of global business confidence, particularly in that flex work sector.
So our mission today is to unpack this trifecta of strategies. First, a really tough geopolitical exit from Russia. Second, seizing a big real estate opportunity in Asia as a competitor falters.
Right.
And third, facing some pretty intense pressure from shareholders for a major financial pivot. Okay, let's unpack this, starting with that difficult geopolitical decision, Russia.
Yeah, the first big one is definitely the withdrawal from the Russian market. This came right after the invasion of Ukraine.
And it wasn't about bad business performance there, was it? It was purely geopolitical, a real halt to their previous expansion plans.
Precisely. And what's key here is how they're doing it. It's not a sudden, messy break. It's more of a tactical, phased withdrawal.
How so?
Well, they're gradually closing their 9 offices across Russia, but only as the existing leases expire. So they're minimizing the immediate financial pain, you could say.
Smart.
Yeah, and interestingly, those offices mainly served international companies. Many of those clients had already decided to leave Russia themselves.
Okay, so IWG is sort of aligning with their client base's own exits.
Exactly. They're basically just tidying up their existing footprint there. No new investment, obviously.
And what's really interesting is how they're framing this. They're shifting focus, aren't they?
They are. The founder, Mark Dixon, was very clear. The priority now is actively supporting companies that have been displaced from Ukraine.
Helping them relocate, set up shop elsewhere.
Right. They specifically mention helping firms move into places like Poland, Romania,
And Portugal, I think.
Portugal, yes. Key hubs for this kind of corporate relocation effort. It's a way to turn a difficult situation into, well, potentially capturing new long-term clients in more stable European markets.
Okay, so that's the exit strategy. But how is this affecting their overall health? Pulling out of a market, even tactically, must have some impact.
You'd think so, but here's what's fascinating. Despite that Russian withdrawal, their global occupancy rates are actually recovering quite strongly.
Really, back towards pre-pandemic levels.
Pretty much. They're reporting figures in the 75 to 85% range, solidly recovering, and pricing is improving too.
Wow, so even with losing the Russia business, the overall demand for flexible space is strong enough to push them forward.
It absolutely suggests that. It looks like that permanent shift towards needing flexible options post-COVID is really kicking in, enough to buffer them against specific geopolitical hits like Russia.
What's fascinating here is how they're managing this retreat while core numbers are actually getting stronger globally.
It speaks to the underlying demand.
It's impressive, managing that kind of complexity. But okay, let's shift gears. While they're retreating from Russia, they're making a very different kind of move in Asia, much more opportunistic.
Ah, yes, Hong Kong.
Here's where it gets really interesting. They're basically capitalizing on the struggles of a major competitor, WeWork.
That's right. Specifically in Hong Kong, a prime location. This is pure strategic opportunism playing out.
So what happened exactly?
IWG is taking over a pretty substantial space, 32,000 square feet in Hai Son Place, Causeway Bay. That's a top-tier address.
And WeWork was there before.
They were. WeWork left that spot back in April. The reports suggested it was due to, the uncertain economic outlook hitting the smaller businesses and startups that were a big part of their client base there. Couldn't sustain the high rent, presumably.
And IWG swoops in.
Exactly. And this move really highlights IWG's model, doesn't it? That asset-light approach we hear about.
How so?
Well, they aren't spending huge amounts buying the building or doing massive redevelopment. They're taking over an operational lease from a competitor who couldn't make it work. Less risk, instant prime location.
And crucially, I read they're getting this space at a lower rent than WeWork was paying.
That's the key detail, a lower rental rate. That's a huge tactical advantage in a market like Hong Kong.
It makes sense. For companies needing longer-term serviced offices or flexible solutions in Asia-Pacific, that kind of cost efficiency in a prime spot is very attractive. It offers predictability.
Absolutely. Reliability and cost effectiveness are huge selling points for corporate teams looking for solutions beyond just a few days.
And this specific location lets them launch a particular brand, right?
Yes, it allows IWG to introduce their more premium offering, Signature by Regus, into the Hong Kong market.
And they already have tenants lined up.
They do. They sign their first corporate client straight away, taking up 25 seats. It shows they didn't just grab the space hoping for clients. They likely knew the demand was there.
It suggests a very calculated move.
And the timing was right, too, because the broader market context matters. Rents in Causeway Bay generally have dropped noticeably.
So the market conditions created the opportunity.
Precisely. Market weakness allowed them to make this opportunistic strike. It's very different from the sort of speculative high-cost expansion we saw a few years ago in this sector.
So what does this all mean for the Asia-Pacific flexible office market? It really shows IWG playing a smart, strategic game, leveraging competitor weakness.
Definitely. It shows a shift maybe towards more cost-conscious, asset-light growth rather than just grabbing space at any cost. IWG seems well-positioned for that.
Okay, so we covered the geopolitical retreat and the opportunistic expansion. Now for the third pressure point, the internal financial battle.
Right, the shareholder pressure.
Yeah, this involves a major shareholder, Buckley Capital Management, pushing for something pretty radical, moving IWG's entire stock market listing.
If we connect this to the bigger picture, this really drills down into how the company is valued and perceived by different markets.
What's Buckley's main argument?
Their core point is about valuation multiples. They argue pretty strongly that shifting the listing from London to New York would result in a significantly higher valuation for IWG.
Why the difference?
Well, the thinking is that the London market tends to see IWG primarily as like a real estate company just leasing space, which typically gets lower valuation multiples.
Okay.
Whereas the U.S. market, Buckley argues, is more likely to view IWG as something else, maybe more like a high-growth, asset-light platform, something scalable with recurring revenue.
A tech-enabled service platform almost.
Kind of, yeah. And that kind of platform story often unlocks much higher valuation multiples in the U.S.
Has IWG responded to this? Are they just ignoring it?
Not entirely. They haven't fully committed, but they have taken some steps that look like preparation, sort of paving the way, perhaps.
Like what?
Specifically, they've switched their main financial reporting currency to U.S. dollars, and they've adopted U.S. accounting principles, GAAP.
Those aren't small changes. That does suggest they're taking the possibility seriously, or at least want to appear aligned with U.S. market expectations.
It signals something, for sure. But Buckley Capital isn't just asking nicely, they're pushing quite hard.
What else are they demanding?
Beyond the listing switch, they've also suggested a major share buyback program to boost the stock price quickly.
Okay, fairly standard activist playbook.
True, but they went further. They basically said that if management doesn't take steps like these and the share price doesn't improve significantly, then leadership should seriously consider selling the whole company, maybe taking it private.
Wow, okay, that's not just a suggestion. That sounds more like a threat.
It's definitely aggressive language. It puts real pressure on the current leadership and strategy.
But is it realistic? Can IWG really juggle a massive share buyback, a potential complex listing move, while managing the Russia exit and the Asia expansion? That's a lot.
It shows the intense balancing act they're performing. Leadership acknowledges the U.S. listing idea. They've made those accounting and currency changes. But they clearly haven't prioritized the full move yet, despite this very vocal, very demanding major investor breathing down their necks.
Okay, so let's pull this all together. A quick recap for you listening. IWG is doing three huge things at once. One, a careful, phased withdrawal from Russia due to geopolitics.
2, an opportunistic expansion in prime Asian real estate, basically picking up where a competitor left off, but cheaper.
And 3, dealing with intense internal pressure from a major shareholder demanding a U.S. stock listing to try and unlock a higher valuation.
And the key takeaway, really, is that if you want to understand a global company like this, especially in the flexible workspace world, you have to track all these things simultaneously. Geopolitics, specific real estate deals like the Hong Kong one, and the big financial pressures, it's all connected.
Their whole business seems built on needing to be incredibly adaptable and quick.
That's the name of the game in this sector. Speed and adaptability in a really volatile global environment.
So what does this all mean? It means the world of flexible workspace isn't just about nice offices. It's defined by this relentless pace of strategic maneuvering. IWG is showing they can play on all three chessboards, geopolitical, operational, and financial at the same time.
Which leads us to a final thought, maybe something for you to keep an eye on.
Go on.
Given that IWG has already taken those significant steps, switching to dollars using U.S. accounting, how much longer can the leadership realistically hold out against that shareholder push for the full New York listing?
You mean before resisting itself becomes a problem?
Exactly. At what point does not making the move become a bigger strategic liability than just doing it, especially if the valuation gap persists? That's the financial showdown that's likely still unfolding. Definitely one to watch.